All right, and I believe we are live. Yeah, we are live. What is going on, guys? We got a lot going on. Okay, there's a ton of drama that we're gonna cover today. I'm so excited. Like that, I'm so excited about this coming week. Last week, all the drama that happened over the weekend. Man, we got so much to cover. Thank you for joining us. I hope you guys are having a chill weekend, and yeah, let's dive into it. So, I have Fahim from Foolish Investor Channel. Um, Thank you for joining, brother.
No, thanks
And
for having us.
I've also got Jesse from the Plant Stock Channel. They're here to try and help me make sense of what the hell is going on. All right. And then also you guys as well. Thank you for joining us. We really appreciate you guys. If you have any questions, make sure you drop it in the chat box. There's a little bit of echo there. But yeah, if you have any questions, drop it in the chat box and we'll try and get through to it. But like I said, we're going to cover the whole market sentiment right now. We're going to cover earnings next week, which is going to be huge. It's going to be huge. We're going to talk about Microsoft. We're going to talk about like if we have any mega caps or large caps on our radar. And also we're going to talk about how to invest in a down market, how our approach is in terms of staying disciplined where there's loads of blood, right?
Yeah.
But I think it will be rude of us to not start with the biggest drama over the weekend, and that's our brother Meet Kevin. He the boat, right? Took the boats and left. So we gotta talk about that. But before we do, Fahim, please, bro, introduce yourself. Let the people know who you are.
So I'm the Foolish Investor. Obviously, got my channel mainly talk about what TTCF. That's probably 50% of the content. TTCF. We're just trying to. What? It's the no hype investing channel. That's the best way I can introduce myself. What we try and do, I try and show you actual facts, figures, numbers, bull cases, bear cases. I felt that was the biggest thing lacking on YouTube. Nobody shows the numbers and nobody talks about the bear case. It's just this stock's going up, and that's definitely been costing a lot of people money, I think, for the last 2 years. So that's what I'm all about.
Top man. Cool. Guys, in terms of DD, Fahim goes in depth. So the link to his channel is in the description. Give him a check out if you haven't. And then Jesse needs no introduction. We've been through the trenches in a Tattoo Chef earnings calls together a few times. But bro, just in case, if you don't mind introducing yourself, bro.
Yeah. So I focus on plant stocks like Beyond Meat, Tattoo Chef, Oatly, the Very Good Food Company, to name a few. So I basically focus on that sector. I cover the news 5 days a week at least, and then I do interviews. I do some analysis when I have the time. And after last year in 2021, when it comes to disruptive growth companies like plant stocks, I should probably be called the bigger foolish investor or something like that. But we all good. Yeah. We all good. We're here to help.
You're hanging in there. I mean, the plant stock right now is the whole sector just being absolutely destroyed. But then now everything's getting destroyed as we speak. Even Ethereum, Bitcoin, cryptos having its fair share. Nowhere is safe. But yeah, guys, check out Jesse's channel. The link to his channel in the description. And you guys know who I am. My name's Emmanuel Finance, and I have a bit of Celsius right there. You know what I mean? Little product placement. So we're going to get into it. And thank you guys for joining. You can see all the questions coming in. We're going to get to it. But first, if you haven't heard the news, Meet Kevin pretty much liquidated his entire portfolio on Friday. He's Tesla. Affirm, everything gone. He liquidated about 99% of his stock portfolio. And for him, I think you said he's only holding AMC left, right?
Yeah, I think so. I know he said 99%, so I'm guessing he's holding AMC because he did say that he's going to keep his promise to what he said when he was doing his whole election thing, where he said he's going to hold AMC for a year. So I think he's holding on to that. But everything else is gone. I mean, Tesla, all the long-term hold stuff is all gone.
By the way, I haven't seen him for a while.
Yeah.
So does this mean that he changed the hair color again or something?
He's got his hair off now. Actually, his hair's gone with his cash as well.
There you go. That's easier.
Yeah, yeah, he's kind of joined me, kind of. I think yeah, the hair's gone. But yeah, since he's sitting on AMC left, and he's gone short the Nasdaq, right? He's gone short the Nasdaq, so he's
He's
pretty
short,
much.
I think, with 5% of his money. He said he's shorted with just
Yeah,
5%
yeah,
of his portfolio short.
5% of his money short. And then he also tweeted today that he's going to start refinancing some of his properties to get ready to buy the dip in March, right? So in terms of like trying to time the market, this is it in full force. Do you know what I mean?
Yeah.
So for me personally, this is my thoughts. It's like, okay, he gave his rationale. I've never seen anyone so focused on macroeconomics as opposed to the actual fundamentals of the businesses that you've invested in. Like that's all out of the window. Do you know what I mean? Like he's done so many DCFs on Tesla, projections, forecasting, all of the due diligence that he's done on many of the companies that he's invested in. It's all out the window. All out the window now because the stock is down or the ticker broke support. It seems a bit ludicrous to me. But like I was discussing in my Discord, I feel like he might be right in the short term. Okay. I mean, bloody hell, what's his name? Michael Burry was right in 08, 09. He was right. However, what has been the long-term trend?
Yeah.
It's been up and to the right. So yeah, you can be right in the short term, but the market eventually recovers and continues higher.
We have to remember a lot of these gurus that they can be. It's enough for them to be right once or maybe twice, but they could still be wrong 10 or 20 times, and nobody remembers that. So
why risk? Well, I just don't see the point of risking your entire portfolio to try and be right in the short term. I don't know. It doesn't make sense to me.
No.
I was listening to Graham. Graham and Jeremy were talking about it because they had the Millennial Money podcast, I think, yesterday. Him, Jeremy, and Andre were talking. And I think Graham was basically saying, look, Kevin's got like $20 million, right? And he goes, he doesn't need to be in the market. So rather than take the risk of his money dropping, he took it out. And I guess that's the difference that people watching Kevin have to remember. Like we might have 10, 50, 20, $30,000 invested. It's different. Kevin's got $20 million invested. That's a huge difference. He doesn't need the market to build his wealth. His wealth is already built. His wealth is already built. He's not trying to build long-term generational wealth through the stock market. So we've got to approach things really differently, I think.
But the thing is, what I feel, I might be a bit too harsh, is that he has 1.7, 1.8 million subscribers. I mean, he's impacting a whole generation of investors, right? Young investors, I would say, especially. And he's been talking now for 2 years, 1.5, 2 years about long-term investing, that being the best. And I know that he's done some short-term trading every now and then. But I mean, the mindset that he actually creates first for himself, because even though my understanding is that his history, his background is really real estate, right? He's a pretty new investor anyhow, if we compare it to Jeremy or some of the big ones who's been doing it for 20, 30 years, right? So the mindset he's creating now, I think, could be dangerous because, I think everyone every now and then gets this, itchy fingers, like Chicken Genius calls it, that you want to go in and you can see it. And I've seen so many opportunities in the stocks that I cover that I could have made a lot of money, but I always have that keep in mind that when you start doing it, depending on what you're doing, and even if you get a routine, it's really hard to stay that discipline and keep it.
This is what happened, in my opinion, when it comes to Kevin. I'm actually going to release a video on this later on where I'm talking about how he what thing is. So when it comes to Kevin, this is the thing. If you're in the courses, if you're in the private Discord, Kevin is a long-term buy and hold investor. That's what he does. If you watch his YouTube channel, you assume that he's a swing trader. If you watch the YouTube channel, that's what he's talking about 24/7. In the courses, 90% of his portfolio is long-term buy and hold. But what happened is when GameStop took off last year, his channel completely shifted. Like before that, you'd open his videos, there'd be like a fundamental analysis on like Tattooed Chef back then, or killing like a hype stock like Hillion, like, you know, these are the risks that are there. That's what his channel was. And then GameStop really hit off and everything really switched for him. He became like a fully, publicly anyways, a swing trading channel. Privately, what he tells his course members is all about long-term investing. I think the problem is for new investors, if you haven't fixed your investing mindset yet, like you don't understand what your thought pattern should actually be. Like I can watch Kevin and understand that's a swing trade, you know, this is what this is. Well, if you're a new investor and you've not learned time in the market, over time in the market, long-term investing, buy and hold, and you're watching that, of course, it's like so confusing. You're like, oh wait, I just paid you $600 for a course where you taught me never sell, like your sell button should be broken. And then you're out here saying like I'm selling everything. So obviously, I think if you're a new investor, it's really dangerous, to be honest, to be following a channel like that where everything's changing 24/7.
24/7. Yeah, I think you're absolutely right. But I mean, we can no longer call him really a long-term investor, because, like, you know, I tweeted this out. I said, you know, we're all long-term investors in a bull market. You know, it's so easy to be a long-term investor when everything's going up, you know. And if you think about it, the Nasdaq's only down, right, year to date, I think it's down 11%, right? So really and truly, we're correct. We're only in correction territory, you know. And if already you're cashing out, you're throwing away months worth of fundamental analysis, due diligence, then you've got to really ask yourself, like, was there really any conviction there in the first place? Because nothing has changed from the business point of view. Yes, you're trying to you're using Google Trends to try and, I mean, like, we're getting desperate now. You know, when we're using Google Trends to determine what our businesses will do, like, there's a problem. You know what I mean? Like, you've got to look at the company itself, not look at bloody Google Trends and then use that to determine what's going to happen. And again, who cares? It's short term. At the end of the day, do you know what I'm saying? Like, it's never up and to the right constantly. You know, there's going to be blips. Like, if you study just a little bit of history, you will understand that there's going to be periods where, you know, the market will pull back. It doesn't just always go up.
Exactly.
And, you know, he's been an advocate for buying every damn dip, right, throughout 2021. And now just kind of capitulated. And I agree with Fahim, is sending the wrong message out to his audience. And there's going to be a lot of people who follow him, like a lot of his sheep will follow him into this, you know, liquidating their, because he went last month, he was talking about, you know, going into 2022 with no cash. So he went all in December, right? And then a couple of weeks later, he's sold out. So again, the market's gone lower.
You know, forget that on Thursday, he put 1 point something million into the market. There was like a 30-minute video.
In SoFi, it was in SoFi.
I put $1 million into the market today, and then the next day I sold everything. That's the kind of stuff that, of course. But then, you know, there comes a point where, as investors, as like responsible people, we've got to take responsibility for what we're listening to, who we're listening to. You know, on YouTube's a business. Like Kevin has made the best decisions for his YouTube business in terms of growing his channel, talking about what people want to hear, keeping the views. While everyone else's views in the space have been declining, his have been skyrocketing. They stay steady. He's still building and building. So he's made the right decisions for him. But as an investor, you've got to make the right decisions for you. Like, listen to this and say, is this actually the right thing for me to be listening to? And then you can't turn around and blame the guy for your mistakes or things that are going wrong, because you've got to make that decision.
I got to give him one thing, though, is that he actually disclosed that information, though, to everyone, that that he didn't sell off everything, and then he didn't mention it to people. So
no, he's not a scammer. I don't think Kevin's any kind of a scammer at all. Like, he's transparent. I just think the advice is bad. That's all it is. For new investors, it's bad advice.
Yeah, true. I agree on that.
Okay, so I'm gonna pull up a quote here, right? So it's from Brian Feroldi. I follow this guy a lot on YouTube, right? I'm gonna share it with everyone now. Okay, let me share it. So you got a quote here. So investors who think in decades have a permanent advantage over investors who think in days.
For sure.
Right?
For sure. So
like,
no reason to stress then, right?
Sorry?
No reason to stress if you have that perspective.
Exactly. It's like, this is what I don't understand. It's like, he's in many videos, especially with Tesla. He's forecasted all these delivery numbers, these projections. The robo taxis, everything. Like he's fully aware of the fundamentals. Yeah, okay, stock resistance, and you're out. It's like
he's the one who he stated, I think, several times and had videos and going into the depth, like you said, that Tesla will see it like in the next 10 years around between $8,000 to $10,000, right? If that's what he truly believes in, then yeah.
He did say, like, to be fair, he did say that he's going to buy back within 60 days. So it's not as if he's long. Yeah, I'm not saying there's a point, but it's not as if he's long-term decided to take his cash out of the market. I don't know why. It doesn't make sense to me, but he has said he's buying back in 60 days. That's he sees that he sees bad catalysts in January and March. So he's like, like from I don't agree with it. It's not what I do, but from like a guy that's got 20 million in the market doesn't need it there, and he's like seems like 90% sure the market's going down in the next 3 months. Like I get it. And I get that we then have a different kind of take to what he does. If you had $20 million in the market,
value matter though, Fahim, though. Like, okay, yeah, I get he's got 20 million, fine. But should
I think
really
the thing
matter?
that he did is he put nearly everything he's got in stocks in the last couple of years. That's probably why it matters to him.
So that's the issue. You've invested with money that you need in the short term.
I think so, yeah. I think there's some people talking about how he's taking it out for some kind of business venture or something that he needed, but I don't know.
No, I think that's nonsense.
People
I've heard rumors about that. I don't think he said that in his live in his public video. He didn't mention that.
I will check his course stream. Actually, it might be in there.
Yeah, but this is the point. Investors who think in decades have a permanent advantage over investors who think in days. And I think that's what it boils down to. Of course, he's built his channel looking at day-to-day, stock gyrations. All of his live streams, they're focused on the day-to-day activity. Support resistance here, Fibonacci here, this, that, and the other. And I think now, because he's been doing it for quite a while, his mindset is almost converted, as Fahim said, like over 2021. He started off as a long-term investor, but has now switched to a swing trader that focuses on the day-to-day. Because, okay, look, he might be right. The stock, I mean, we've got earnings we're going to get into, and after what Netflix did last week, there's a high probability that he'll be right, and the market goes lower, especially if Apple and the big boys, report slower growth and outlooks. It might be right, but is it really worth then throwing it away, taking losses, realizing huge capital gains to only eventually buy back in March? But what if it continues going lower in March? We can't. No one knows. No, we like to think that we know, but nobody knows. Not even the Fed knows.
I think what go on, Jesse. Sorry.
I like what started listening a lot to Tom Nash, and I actually like what he kind of talks about that. Yeah, that we might, like you guys are talking about, we might see the market going down more and more. We might bleed more in the next couple of months, and when we get some form of decision, more clarity from the Feds in March, then it might be time to start going in. But the question is, we probably not even then need to go all in, because it's not like we're going to see them just flip like this and go up 100% in a couple of weeks or even months, because it's going to be a slow growth pattern again, I think.
Yeah.
I think what really shows, like, how hard it is to try and predict what's happening. Because let's have a look here. Early in the year, the biggest fear was the economy is too hot. We're inflating. Inflation's really high. That's the biggest fear. Interest rate hikes are coming. Now the biggest fear is the economy is slowing down. So inflation is going to go away, and we might not get interest rates, and companies might not make a lot of money. So this has all happened within the space of like 6 months. The economy is impossible to predict. You can have like a best guess that this is going to happen. Right now, we don't know if the inflation is going to just stay really high, and we're going to have to keep hiking rates, or if Elon Musk and all these guys are right, we're going to see a recession, and Netflix has seen a slowdown, and Apple's going to see a slowdown. There's no way to guess what's happening.
You know what's going on in China, right? I'm not sure. You guys listen to the All In podcast, right?
No.
Yeah.
Okay. So, and there were, I think Shamat and Sachs, they were talking about that in China. They're actually lowering rates, right?
Because they cut rates.
Because they realized that that people are going to stop buying, and we're not going to see production in the same way.
I actually do
So
think that we're not going to see the rate hikes that we're pricing in next year. I don't think it's going to happen.
Hmm.
But
Yeah.
that's just my thoughts, obviously. But what I'm saying is trading off those guesses is because you're just guessing. You've got no idea where it's going to happen. Like Peter Lynch said, like, knowing where interest rates are going would be amazing. Like being able to trade that information would be amazing. You'd be a billionaire if you could guess interest rates 5 times out of 10, but you can't.
Yeah. You
So
can't. No one
just
can.
don't worry about it.
Yeah. All right. So yeah. On that note, then, so let's into the interest rate hikes. Again, it's anybody's guess, in my opinion. I've heard people talk about 4 hikes this year. So I mean, I've heard wild claims of 7 hikes.
yeah, 6, 7.
I've heard what this. So Jesse, you think there's going to be 6 rate
No,
hikes
I don't
just
think.
this year?
I'm not saying I think that, but I do feel that. Yeah, I've heard some experts and banks saying that we could see 6 to 7 hikes.
Yeah.
And this, yeah.
I mean, I saw JP Morgan as well talk about 4 or 5 this year. I mean, it's interesting because the same JP Morgan analyst was talking about Bitcoin was going to 100K by the end of 2021. Got it completely wrong. So again, I don't know how these guys get so much airtime for being so wrong. And
Do you know what's really funny is the analyst price targets. Like when the stock is going up, the price target is 60. As soon as the stock goes going down, the price target is 40. Like the price target just changes. Like how can you 3 months later, just because the stock went down, your price target change all of a sudden? It's nonsense, man. It's absolutely
several analysts just follow the momentum basically.
Like 2 years ago, I set a price target on Tattoo Chef for 2025. I've got the same flipping price target that I had 2 years ago. Nothing's changed.
What is it, like $500?
Jeremy will be happy with that. Yeah. But is this changing your investment approach? Like, are you now switching up your portfolio strategy in line of with expectations for rate hikes? Because I know certain people are talking about, well, at the start of the year, certain people are talking about buying more bank stocks because obviously they will benefit from a high interest rate environment. But I mean, we've seen banks, they've tanked recently. So will you be adding bank stocks, JP Goldman Sachs to your portfolio, or no? What do you think, Jesse?
Now, if I would add anything to anything within the financials, I'm invested in Block, former Square, right? So definitely with the prices, the way it's gone down to all like 52 weeks lows right now, I think it's under $130. It was up, and I remember a couple months ago I was up at like $280, $290. So if anything, I would invest more there if we're talking about banks and money, financial sector.
Yeah, I mean, Square's been beaten up, isn't it? It's now wow, 118. Wow. So are you buying? Are you buying now then, Jesse? Or
I would if I could, but no, right now I would probably, if I would be like you guys know, we're expecting a baby now in April, right? So so I'm very careful with the money right now.
Make sure you buy the honest diapers,
honest diapers add to the revenue.
Exactly. So, but I would probably be buying. Not just because that's what I work with, but I would be buying Oatly and Beyond Meat at this point.
Okay.
Yeah.
What about you, Fahim? Are you switching your investment approach strategy in line with rates? Not defensive approach.
Not in line with not stuff like going for banks because rates are going up, because investing in EVs because EVs are coming is one thing, but investing in banks because interest rates might rise, it's not something that I would do, because I might be wrong and they might not rise at all. But what I've tried to do is I've tried to start incorporating much more profitable and free cash flow positive companies. I think during 2020, 2021 it was all great but anything speculative was just going through the roof. And obviously I believe in my growth companies like Tattooed Chef, but I also want to incorporate those profitable companies because obviously it's just they've proven their profit potential. They're more able to withstand a market downturn. Even in the smaller cap space, there are profitable opportunities. So I've started to look a little bit more at some of the more profitable companies. I think that's the only shift
so you don't agree with Kathy then, and I think that we will see valuation companies actually taking the fall later this year.
No, I'm not talking about value stocks. I'm just talking about stocks that have profits. So I'm talking about like Adobe.
Give
Adobe
us
has
some
more.
tickers. Give us
Yeah,
some tickers.
like if you look at Adobe, right? People say that's a boomer stock, that's old. But it has more growth than Corsair Gaming. They're growing revenues faster than Corsair Gaming, growing earnings faster than Corsair Gaming, and they're profitable and have $7 billion in free cash flow.
Right,
but they're growing at the same rate. So I'm not talking about stocks like Coca-Cola. I'm talking about like Adobe, Align Technology. They grew earnings around 300% in 2020. They grew revenues 59% this
And
year.
what about T-Doc?
Massively. T-Doc is my biggest position. That's still there. But obviously that's the money losing one. That's the one I'm holding for the long term.
But they're doing pretty good, aren't they, financially?
Say that again, Jesse.
Yeah, but T-Doc, otherwise, they're doing pretty good financially, my understanding, when it comes to revenue.
Revenue is good. Profit's not there. The problem is most people are looking at net income. Adjusted EBITDA are taking out their stock-based compensation and acquisition costs. They're actually highly profitable. They've got around a 13% adjusted EBITDA margin. So in my opinion, it's only a matter of time before that starts translating down to the bottom line once the acquisition costs start to go away. So looking deeper at the financials, they are really they are profitable in terms of the underlying business, but in terms of accounting, no. But at $80 for me, like I've still got my price targets the same, somewhere between $350 to $450 by 2025, and seeing this at $70, $80 for me, I love it.
Look at it.
Never been happier. That's what
So
I mean.
You're actually excited about this chart.
Of course. Like, come on, Emmanuel. You know what it's like. You know when you believe in a company, you know where it's going. And you know when it was 200, and I was like, oh man, I can only double my money. Now it's like $80. I'm like, I'm gonna 4x my money in 5 days.
So it doesn't phase you, or it sounds like you get more excited the lower this is going.
Yeah, 100%, man. If I've got conviction, the lower the stock goes, the happier I get, because all I know is that my long-term returns are improving. Because I didn't stumble across T-Doc until they were at about 120, and then I was buying it, and but obviously all that time I just wanted it to go lower so I could just build out that position in a big way. And now it has, so I'm not going to complain about that. It's at 2019 prices. Revenues in 2019 were $500 million, and today they're $2 billion. So revenue has like 4x, and the stock price is the same.
Same.
So
same. This is when the market is irrational. Rationality escapes the market, and this is where opportunity is had. I've been watching T-Doc. I like T-Doc. Obviously, HIMS. I've been in HIMS for. My average in HIMS is about 8s now, in the lower 8s. But I mean, T-Doc, I'm looking at T-Docs and it's just getting more and more attractive. As you said, right now it's trading at 2019 levels. It's a bit ridiculous. But again, okay, so let me pose this to you though, Fahim. One of the things I've been seeing online is people are now saying, oh, the company is not profitable. That's why. But then if you look at, like you mentioned, Adobe's tanking. Adobe is very profitable, right? Many companies right now that are profitable, non-profit companies as well, all getting hit. There's just no escaping it. So
I think the reason, like, you've seen a lot of these companies get hit, and I think one thing people haven't understood is the markets were overvalued. Like, they were overvalued. Most things were overvalued at the start of 2021. So what did you expect to happen? Like, from 2019 to 2021, the S&P has gone up more than it has for like the 10 years before that. We're up 100% in just 2 years. And indexes, large caps, have been overvalued. So like, it's not going to surprise me if Netflix, Apple, Google, all of these stocks continue to fall even more, because they've been pricing in strong earnings growth on the S&P with that 28 multiple, and it looks like that growth isn't coming. So
but then what about companies that, like, okay, small and mid caps, right? So we know 2021 was a rough year for small and mid caps, even though a lot of the ones we've invested in have been growing. So for example, Celsius, it grew revenue 159%. HIMS also grew revenue 74%. OPENDOOR is about to report 1,000% growth year over year in Q4. But regardless, they've been hit. They've kind of been painted in the whole SPAC is trash, pretty much brush.
And the chef is like 45% something.
Exactly. Tattoo Chef as well, 40% growth year over year, but the stock just continues to get destroyed. So with now the overvalued market in SPY falling, does that mean more pain for these small and mid caps that have been performing well but been hit throughout 2021? Or does this spell a rotation out of mega caps and into small caps that have already been beaten up?
I personally think like in the smaller mid-cap space prior to the crash, a lot of them were overvalued. Not all of them. A lot of them were overvalued. They were just pricing in like it was just basically pricing in perfection. Like every small cap SPAC stock, you were just pricing in that this was definitely going to happen 5 years from now. This is definitely the case. And of course, when interest rate hikes come, people look for lower risk returns, and it is more risky to be in smaller and mid-cap stocks than it is to be in larger cap stocks because the thing's less certain. Like, yeah, I believe TTCF could get to here in 2025, but could they also not get there? Of course, there's also a big possibility they might not get there where I want them to get to. And that's the risk that then gets priced into smaller cap stocks, especially when interest rates rise. But I think in the smaller mid cap space, I think if the stock itself, because you can't generalize them, if that stock itself is now like trading 10-20% below its fair value, I don't think it's going to go that much further. I don't think Tattoo Chef's going to start going to $7 or $8 because I think it's already like 10 to 15, maybe 30% below its fair value where I see its fair value. I don't think it's going to go that much further. You still have some stocks that, like Lucid, for example, is probably well above what its fair value should be. So could it drop another 50%? Yeah, I think it could. Like that could happen.
Yeah. What's your thoughts, Jesse?
Yeah, funny when you talked about the chef. I had a question from one of the subscribers in my Insta yesterday that could I see Tattoo Chef at $6? And trying to look for that future, and I kind of have a hard time seeing it going below that low, actually, or below 10. But
you don't think so?
If Sam sells.
If Sam Gilletti's like, you know what? Screw you lot. I'm out.
but I actually do believe that this is the year of the small caps and the smaller mid caps.
Yeah, I think Chamath said that, right? Chamath believed that as well.
And actually several fund managers too of hedge funds, because this is going to be a year when I do think that valuation companies and bigger companies are going to start to lose when it comes to stock price, because people who make money and have money, they're going to want to keep making money, right? And they're going to see that it's going to be difficult to make money on the larger cap companies this year. So, and considering, like we've talked about, that many of these companies have gone down to either all-time lows or gone down 50%, 70%, 80%. And if you look at them, and if it's a disruptive growth company, you understand the future, you see that have a future, then you know that it's the market that's overreacted, right? So
I think it depends though, Jesse. I think this is where most investors make a mistake, is they haven't learned anything about valuation. So they say the stock's gone down 50%. Okay, so it must be a buy. It doesn't mean that it's that fair. A stock that can drop 50% and still be overvalued. So the key really,
obviously some of them deserve it. There's no question about
and
that.
You've got to like, even Tattoo Chef, if it reached $50 and then dropped to 25, does it mean it's not overvalued? Not exactly. So you've got to look at that drop, see where is it now compared to where it should be, really value it, and then if it's a fair value, then okay, that's the stock to buy. Not just, I think a lot of people have kept losing money because they saw something drop 20%. So it must be a deal, grab it, and then it drops more. But it's still expensive.
Peter Lynch that talked about, what was it, Panorama, or what company was it?
I can't remember what company it was, but he gave a lot. He was basically saying a cheap stock can get cheaper if it was already, or even
you keep buying,
and especially if it's already expensive and it goes to $5. Don't think it can't go to $1. It can go to $1.
Jesse, that people just talking about Polaroid. If it drops below 100, buy everything, and then it went all the way down even further. And this is the thing, I think, not a lot of these companies are not going to survive. We're always talking about the market will recover, but in reality, not everything's going to recover. Like I've got Workhorse's chart up here. I'm saying, like if you go back to like the .com,
is it $3 now?
It's $3. Yeah.
Oh my god.
You know what I mean? But like, that's like Fahim saying, it's like, can you look at Workhorse and say, oh snap, it's down, this is a great deal? No, because if you look at the .com crash, every company that came public, doesn't matter if they had any revenue, all they needed to do was put .com at the on their company name, and it was flying high. Pets.com, and so many other companies at that time didn't make it. Do you know what I mean? But in the midst of the rubble was Amazon's. Do you know what I'm saying? Was your Qualcomm's, your Microsoft's, was your eBay's. You know, they were all amidst that. But then, so the fact that the stock is down doesn't mean it's going to recover.
True.
But one thing, you know, when I look back to like the .com bubble, the crash, the companies that survived are the companies that, you know, like Fahim said, you know, they're growing their revenues, growing their, strengthening the balance sheets, approaching positive free cash flow. Like the business is continuing to improve despite that. And then these are where the gems are. These are where the bargains are. But like, you know, if you've got like Workhorse, which generating hardly any revenue, you know, I think they delivered like 20 trucks last year and they've been recalled now. Or even Nikola, you know, these type of companies will not survive unless management changes something drastic. They're going to go bankrupt.
You know, there's something Peter Lynch said, Emmanuel. You probably heard it, man. But I think it's so important to remember in this time because, like, let's say Lucid, for example. Like, sure, they could end up selling 100,000 cars a year, but sure, they could also end up selling 100 cars a year. We don't know until the car reaches the market and we see the market's reaction to the cars. And what Peter Lynch said is, look, when Walmart came public, you could have 10x your money if you bought after 5 years. You could have 10x your money if you bought the 5 years after that. And you could have 10x your money if you bought the 5 years after that. You don't need to buy the company right at the start. If you want to wait until you can see more proof of concept that, you know, this is actually working out, you got time to do that. And it's much better to do that than to just be like, you know, how can you be sure that Lucid's car is going to be well received by the market until you actually see 5,000 customers reviewing that car? You can't.
But that's why actually, not to break the flow here, but when I think about Oatly, I don't know how much you guys have looked at Oatly. That's actually a company that's 3 decades old and has been growing it's been growing until 2020 about 100%, and now it's around 50-60%. And actually, Wall Street is very much on Oatly's side. They actually expect them to be they feel they should an average should be around $15, and it's around $6 right now. And they've been producing. And when they actually came out, IPO'd back in May, I actually did warn my subscribers that, you know, maybe wait this one out because it's going to be extremely overvalued. But it's a great company in itself, but still extremely overvalued. And now at the price they're at now, when you think about investing now, with the kind of price to sales that we're expecting them to be at around 1 to 2 years, around 3 maybe. It's an amazing opportunity now. Obviously, even if you invested at $20 or $25, if you're looking at them from a 5 to 10 year perspective, but the possibilities could be there from $10, from $15, from $20. But you got to have a long-term set there.
100%. And this is a quote, Brian Frody. I think you guys check Brian Frody out. This guy is on the ball with a lot
Brian's
of
wicked, man. Brian's wicked.
Yeah, love that guy, man. But this is what it talks about for him. I think this is hits on your point about, you know, sometimes there's nothing wrong with waiting for proof of concept. Because like here he said he passed on Shopify at 30, 40, 60, 80, 100, 120, and finally caved in and bought at 140. Well, the current price is now down to 800. Don't get that twisted. But at that time when you made that tweet, it was 1,479, which is crazy. So the point is, you can still get in late, and still win big. You know, and I think there's nothing wrong with that. I think it depends on your own risk tolerance.
The problem is, when you try and get in early, like most newer investors are, but you aren't diversifying your bets, you're probably going to run into problems. Like if you're trying to do really early stage, you've got to diversify what you're doing, not have 3 stocks that could potentially make it all and also could potentially lose it all. At that point, you've got to start diversifying what you're doing. That's where the reason that most people are upset about a crash is like that comment that I had on my channel said, my life savings are in Tattooed Chef. Like that's why you're upset and that's why you're really stressed out. But what can we do about that? But if you're going to do that, you are going to give yourself heart. Like, I would never put more than 10 to 15% of my money in the Tattooed Chef, no matter how much I like the company, because it's still highly risky. There's so much that could go wrong.
Yeah, agreed. But I think again, that's your risk tolerance, brother. Do you know what I mean? Everyone is different. Someone like me, if I if I believe in the company and I'm seeing proof of concept early on,
Yeah.
I have no problems getting in early. And then, like I was saying in my Discord, with a lot of people in my Discord are like, oh, Open Doors now down at 9. Are you buying more? Are you buying more? And I said, not yet. I mean, for me, I've put in the amount that I'm really happy with at this stage, and I'm waiting for Q4 earnings. Once the earnings comes out, and if my thesis, my investment thesis, my bull thesis is still intact, then I can reward myself with even more shares. The same with Tattooed Chef. Like, I haven't bought any more Tattooed Chef since Q2, right? I haven't bought any more, even though the stock is crazy. My average is 18 in Tattooed Chef. It's now down to like what, 13 or 12, whatever. But again, I need to see proof of concept, and there's nothing wrong with adding to your position with each earnings report, and it confirms that your long-term thesis is still intact.
His battery went out.
Oh, battery's gone. Still there?
Yeah, I'm here.
You're still here.
Okay, he's still here. Yeah.
I'll try and get it
so
sorted out.
Again, no rush, but again, there's nothing wrong with whether the market recovers and goes higher. If your company continues to perform, that you've been, again, we always forget as well that we are owners of businesses here, right? This is ultimately what we're doing. We're not just investing in tickers, we're investing in businesses. So the company continues to prove itself, then continue to reward yourself with more ownership of the business that you like and are performing. It's really not that difficult.
Yeah.
But actually, like what Jeremy said in a recent video, that if you're still in the market now and you kind of suffer through this, that's kind of a badge of honor, right? Then you're a made man. I mean, so I agree.
So Emmanuel, you know what it is like? You talk about risk tolerance, which is what I believe, right? You've got to have higher risk tolerance. Like, this is why I don't share my portfolio. Actually, one of the reasons I've never shared my portfolio with people is people think then this is a good idea to have I've only got 5 stocks. And people think that's a great idea, but not necessarily. You've got to really have the right risk tolerance. And that's why I don't share it, because I know a lot of people will copy it without. And that's the question I think you've got to ask. Like, everyone says I've got a high risk tolerance. I can invest in high growth companies, but then when they go down, you don't actually have a high risk tolerance. So you got to definitely check that out before you start deciding how many stocks you hold. And now I can hold 3 stocks. For most of 2020, I held 3 stocks because I couldn't find what I thought were good deals on the market. And that was fine for me. Like, it didn't bother me that I might be down 2,000, 3,000, because I knew on the upside, when these got to where they were going to go, that I was more likely to be much higher up as well. But it doesn't mean that you can't do that unless you're actually willing to hold through those times and you know that what could happen.
But I've actually talked about that many times on the channel, and I agree with you, Fahim. If it is that you are a total new investor, maybe you shouldn't go all in 1 or 2 or 3 companies. But all in all, personally, I believe if I can just focus on 3 companies and put all my energy and effort and keeping up to date with them and understanding the business, the sector, the competitions, the CEO, I think I'll be a better investor in that way, because if I had 20, 30 companies, I don't know how I, in any serious way, would be able to follow all their stories.
I agree. I agree. And that's why, like, I can tell you about TDoc inside out, why I can buy at 70. If it was 40, 30, 20, I'm not upset, because I understand that thing inside out. I've spent so much time learning, and you can't do that with 30 companies. It's just impossible. But like I said, then if you're new and you don't understand yet, it's probably not a good idea to do that. Like, it might be a good idea to have most of your money in a fund, and then start learning about investing in individual companies until you can really fully grasp what a company is about.
I mean, speaking of TDoc at $40, if you look at the earnings this week, and if Netflix was anything to go by,
I think TDoc's gonna kill the earnings. That's one thing that's stressing me out. I think Q4 of 2021 and Q1 of 2022. I don't think we're gonna have long to buy the dip on TDoc. Obviously, I'm just guessing here, but what I said about 4 months ago was that the flu season this year would be mad for TDoc, because the CDC said we'd have the highest levels of flu on history, because people were finally gonna come out like they hadn't been for last year. And 70% of TDoc's business used to come from the flu. But in 2020, only about 20% of the revenue came from people coming for flu and respiratory illnesses. And obviously, that's a huge amount of revenue that's going to come back in 2021. And if you look on their Twitter and stuff, what you see is just complaint after complaint about waiting time. And obviously, you can see that as a negative, but I see that as a really like that's bullish. That there's so much demand, and you can't choose not to get ill just because there's a recession, right?
Yeah.
So you got to spend money. So that's one thing I guess I didn't say earlier. I am also looking into more recession-proof companies and again, I don't mean value stocks. I'm looking at growth stocks that also have recession-proof aspects to them, like TDOC. TDOC has a lot of recession-proof aspects to it.
I think Brady said something important. He said guidance is more important than earnings right now. Yeah. But again, a company like Teladoc, like I don't understand how their guidance will be reduced if people are getting sick and people are complaining about the flu and they need the services. Like I don't understand how that's going to affect a company like Teladoc. Like I can understand a company. Look. Okay, if Apple comes out right and talks about they've noticed demand is slowing and they reduce guidance maybe for Q1 next year based on the current trends. Like you don't need an iPhone. Do you get what I'm saying? You don't need the latest iPhone. You don't need the latest iPad. You don't need the latest MacBook or whatever. People need to take care of their health. Do you get what I'm saying? Like,
yeah. Like if HIMS gives low guidance, it doesn't tell you anything about the economy. Like it just doesn't give you any indication of where the economy is going. Like that's like you said, that's your Netflixes, your Apples, your Amazon. Yeah, that's telling you. I think Tattoo Chef might struggle in a recession personally because I think that's like a more it's not your necessity food. It's more kind of like your the thing that you could cross off your list if you had to.
Yeah, exactly. Exactly. Right. So are you guys nervous, excited about earnings this weekend?
Oh, guy, Emmanuel, can I ask you something actually? One second. I had a guy come in my Discord. He works for Publix, and I can't show you on the screen now, but he basically asked me, he goes, in all of the stores across the US, he goes, there's no TTCF products in stock. So are TTCF so are TTCF selling so well, or are they not able to keep up with the demand with all these new stores they got into?
That's the big question. That's the big question. And I think the only way we'll find out is in the numbers. That's it.
Yeah.
The numbers will give us clarity. I've seen a lot of people say that as well. You see a lot of pictures of Walmart, Tattoo Chef shelves are empty. Yeah. Is that a good sign or a bad sign? The numbers will tell. It's anybody's guess. But if they are struggling with supply,
so he's basically sent me a list of all the kind of SKUs that Publix hold, and then like every store where they're supposed to be. And I think, literally, there's no stock in any of these stores. So yeah, I don't know.
Yeah, it's a tough one, and the numbers. I am nervous. Out of all of my companies that I've invested in, I think I'm more nervous about Tattoo Chef. And,
my biggest thing with Tattoo Chef is in 2022, if those extra stores don't equate to revenue, then there's something going wrong. Something is definitely going wrong somewhere.
Yeah. I'm a little bit nervous as well regarding Celsius because, again, these are not needs. You know what I'm saying? These are not Teladocs. These are not HIMS where people need, to take care of their mental health. They need their prescriptions for mental health. These are wants-based businesses, which Tattoo Chef is a wants, it's not a need. Celsius is a want, not a need.
That's kind of the thing I've talked about in my Discord too, in my morning briefings. When it comes to both Tattoo Chef, Beyond Meat, maybe Oatly to some extent, very good food company. These are all right now to some extent premium products, right? I mean, the paradigm shift is coming. We see that more and more people are interested in eating more healthy. They want to try more plant-based. So for me, for sure, this is the future. But the question is, right now, if we are in a state where we have 7 to 8% inflation rates, what is it, up at 5 in the UK or something like that?
Yeah, UK
is pretty bad.
Yeah. So that might be to some extent an issue, because normally I say everyone's got to eat, right? People are going to keep buying food, but will they necessarily buy more expensive food? That's going to put pressure on these businesses to try to come closer to price parity.
That's why I said profit. That's why I said profitable stocks, because if the recession does come, companies without cash on hand, companies that aren't generating free cash flow, they're the ones that are going to have to issue shares, raise debt at expensive rates.
Yeah.
These are the problems. Like if Tattoo Chef doesn't reach profitability, if they burn through the cash that they've got, what happens? They've got to raise money, they've got to issue shares, they've got to raise debt. So these are the concerns you got to keep in place. And then it doesn't mean like don't buy. It means just, to allocate accordingly. Like, allocate positions accordingly. Don't go all in on something that could suffer really badly if the economy suffers.
Yeah, and to be honest, I think it might be of the plant stocks that I cover, the one of them that might suffer a bit more could be Tattoo Chef, because brand awareness, they're still quite new comparatively.
Do you know what's crazy? I was saying this in the video the other day. If you look at Beyond Meat's revenue, it's 400 million, right, roughly for 2021. TTCF is just under 300 million, around 220 million. How can the brands be so close in their revenue? Like, it's not that Beyond Meat's 10 times bigger than Tattoo Chef, really, but the brand awareness is on a different level. Like, you would assume that Beyond Meat must be much bigger than TTCF in terms of revenues, but it's not. There's not that much difference.
Again, that brand moat, that's that value that investors are placing on.
But also how much actually of their money and of their revenue that actually keep reinvesting into their R&D is quite different when it comes to the chef. And also the margins are still way better than the chef. So, but that doesn't mean that, they can't come closer. But I actually do see Beyond this year and next, considering all their deals now with McDonald's and PepsiCo, the young brands, I see them actually flying way further ahead than that. But that's me. That's my opinion.
Yeah. Another point as well is kind of an environment like Tattoo Chef might struggle is they don't have pricing power. Like when I was listening to Celsius's Q3 earnings call, one of the analysts was asking about, how are you battling, inflation and interest rates and stuff like that? Are you increasing the prices of your cans? And the CEO Mr. Foley said they can't at the moment because their competition aren't. Monster, Red Bull, they're still keeping the prices the same. So if they increase their prices of their energy drinks, they could be pricing themselves out. But then if their operating expenses are a lot more higher, then this is going to get hit. Do you get what I'm saying?
Is it addictive?
What, Celsius?
Yeah.
Yeah.
It must be.
Because you can say, people might stop, but that's the big thing, if it's addictive, like people, I don't know if people
that's
stop
a moat.
In a sense,
True.
yeah. I mean, if you need that one, that's the one that you need. That is a moment, to be honest, in itself.
That's true. Yeah. Well, I guess they're going to have to try to exercise, try it out, increase prices and see demand, whether demand falls off. But you are right. If some people, like I was listening to the famous Hollywood actor Jonah Hill talking about Celsius. He was talking about on set, can't live without Celsius. It's replaced his coffee. Do you know what I'm saying? So something like that is very bullish, and it shows that the products there's a stickiness to it. Do you know what I mean? So yeah, we'll see. But I'm not worried. Again, these are all short term. Do you know what I mean? Like if we're really long-term investors, if we're really investing with a decade time horizon, all of this is just part of investing. This volatility phase, Warren Buffett always talks about staying objective and, thinking long-term. That's what I'm doing, So yeah.
Do you know there's a really, I think, incredible quote, man, from Warren Buffett where he said, if you talk investing like this, like take a punch card and it's got like 20 punches on it. And every time you buy a stock, you got to take one punch out, but you can only make those 20 bets in your lifetime. And then this is how carefully you'll start thinking about everything that you're putting your money in before you put it in. And then you'll be more confident with that decision that you made because you've actually done the work beforehand to make sure that it's the right decision.
Yeah.
Right, guys. So let's quickly talk about Netflix dropping 20% after hours. And then now we've got big tech. So, I mean, we've got some big names reporting earnings this week. Again, we know that outlook guidance is the main thing. So got Microsoft after hours on Tuesday. We got obviously 3M, Johnson & Johnson's, GE. Tuesday is a big day. IBM actually as well on the Monday, but I don't think IBM has the power to impact the market. But I mean, your big boys, Microsoft. On Wednesday, you have Tesla. Again, Tesla is most likely going to crush earnings, but again, it's all about that guidance, right? and Tesla can move them. Well, Tesla definitely moves the the Nasdaq. And then you have, I mean, Thursday really is Visa. You got Apple. These are the big boys. Mastercard. Yeah. What's your thoughts then? Are we going lower next week?
Yes. Yeah, I think we're going lower. We're going lower. I mean, these companies are most likely coming out with weak guidance. I think, obviously, I'm guessing, and that's going to send the market lower, in my opinion.
And with that said, are you buying? Are you going to be a buyer this week for him, or sitting on the sidelines?
If I had cash, I'd be buying. Like, if I had cash, whatever I've decided is already undervalued. As long as it's, I have a simple rule, Emmanuel. I think I set my fair value target for a stock. If it falls below that, I buy it. That's the rule that I follow. That's all I do. And if it falls more, I buy heavier. And if it's even further, I buy heavier. And that's just the rules that I follow.
I don't have control of my money anymore. Apparently, my fiance is buying all baby stuff now and cribs and things. So yeah.
So you're going to be staying on your hands, Jesse.
Yeah, I think so. So for now, but I'll be honest. If I had $100,000 right now just to go in crazy with, to be honest, I would start maybe putting in my conviction stocks, especially Beyond and Oakley. Go in there more and more, but I would be doing it slowly, considering that what we could be expecting in the next couple of months. Because Beyond is around $62, $63, but it's not impossible. We'll see them at 50 or under 50. And same with Oakley, it's around $6, but it could go under 5. So I would be careful, even though I'm super, convicted long term.
All right. Okay. And for me personally, I will not be buying this week. Like I said, most of my high conviction companies are going to be reporting earnings early February. So once the earnings are in, once the thesis is still intact, then I'll just reward myself with more ownership of these companies. For now, I'm still building up my cash pile. I went all in pretty much in December, thinking we'll have the January effect this year. It's not played out, but no bother. I've just been working additional shifts at the clinics, working on my business and just using all of the revenue streams to build up my cash pile, remaining disciplined and waiting for Q4 earnings. So no rush for me either.
No.
Right. Okay. So let's have a look in the comments. So actually, I saw someone ask, "What are your highest conviction plays?" So I'm going to start with Fahim. What's your? You said TDoc, right? What are your top 3?
I'd say I'll give you a top 2, because there's 2 that I would say are really high conviction for me, which is TDoc and DigitalOcean. They're my 2 highest conviction stocks.
What's the ticker for DigitalOcean?
DOCN.
DOCM.
N.
Oh, okay.
Yeah.
Not Dark Martin.
Come on. Okay, so do you mind, like, in a minute or less, why is this your second highest conviction?
So I bought here at 59, right? That's where I started my position. I mean, 59, like it just ran up like within a couple. I couldn't do anything, so I've been like waiting for it to come back down. But DigitalOcean is basically, so you've got Amazon Web Services, right? They provide cloud services to enterprises. DigitalOcean is basically that for small and medium businesses. So if you're looking for, like, this is for me the Shopify of cloud computing. So they're providing this, and what they're doing is their value proposition is really that they offer a much more simple service than Amazon Web Services. You've got to research this space. AWS is complex, and pricing is really complicated as well on AWS. So DigitalOcean is simple pricing, simple platform, and they have a huge developer community. Like, developers love the product, and that's kind of a litmus test, I think, for any software. If developers love the product and they're recommending it to things that they're working on, that's incredible. Revenue growth is getting faster every year. So they've gone from like 20% to 30%, 40%. That's what they're aiming for. Just hit profitability as well. So I think this company is going to generate massive amounts of free cash flow. The market size is like around $144 billion is expected to be within the next 4 years, and they're only doing 500 million in revenue right now. And the fact that they have this huge developer community is a massive moat, because people want to use DigitalOcean. they host something called a hackathon. So they actually host the world's largest hackathon once a year, which is one of the reasons why they have such a massive developer community.
Yeah, I was taking a look at their revenue growth. It's been pretty consistent, really, to be fair.
Yeah.
Digital Ocean. What do you think guidance is going to be? Are they going to have got a strong guidance in earnings?
Yeah, I think so. I think so. So what they've been doing is they're basically their revenue. If you look at annual on their revenue, what you see is that their revenue is basically getting higher. Their customer count is getting higher, but what's happening is their average revenue per user is getting higher. Like it's literally rising like 20% every quarter because they're adding new services. So it's like every subscriber's becoming worth more and more. So yeah, if you want, that's a great company to look into, definitely. You can see a comment here. I think your average investor says, all my friends use DigitalOcean for their websites. Yeah, there you go. Like developers love it. Developers love it.
There you go. Okay, that's one for you guys. DOCN is the ticker alongside TDoc. Okay, so Jesse, I mean, do we even need to ask?
Well,
your highest conviction.
Yeah, I mean, everyone knows my conviction with Beyond Meat. I mean, the possibilities with all their collaborations. But what I'm getting more and more excited about now on the side, and to just talk more about, is Oatly. Not only because I'm half Swedish, as you guys know, and I've been following their journey when it comes for here 10, 15 years, and it's actually existed here for almost 30 years. It wasn't called Oatly like 20 years ago, but still and considering what they're doing, their possibilities, because the plant-based shift is coming one way or another, and more people are going to adapt and eat that more for different reasons, for health reasons, for environmental reasons. But what I do see with Oatly is that there's some more simplicity to it compared to Beyond Meat when it comes to adaptation, right? For many people, going from eating meat and eating a plant-based meat version, it's going to take longer time to adapt to. But with Oatly, with plant-based dairy, is already quite accepted.
Jesse, do you know what percentage of British people now drink plant-based milk? I just read it the other day.
Over 50%, I think.
It was 1/3, I think, when I seen it last.
Okay, yeah.
One third of people are now drinking plant-based milk, which is
and of those 1/3, I think it's 53% is actually Oatly.
Yeah. So Oatly has milk. Disgusting though.
What's going on? Here we go. but that's the thing. But that's the thing. Every market that they've gone to right now, in Sweden, have over 50%. When they came to the UK, after a couple of years, they have 50%. In Germany, they had 50%. Now they entered to the US just like 1 or 2 years ago. They're around 14% right now, but they're barely begun in the US, right? They're in China. In about by 2023, they should have about 9 facilities in the world. So I mean, they're going to be the first plant-based company to reach 1 billion, most likely.
Wow!
And they might actually do that this year. So because analysts thought they would grow revenue about 60% this year, but what's going on in the world, they've taken it down to 50%, which is still pretty good. And they have margins now around 27%, but they are expected to get them up to about 40% soon again.
Jesse, one question for you regarding Oatly. So this is one of my biggest things the issue that I had was, let's say, like around 3 years ago, the biggest thing was, I think, soy milk. Then it was almond milk. Then I don't know, but it's gone through various cycles. So what happens when oat milk is no longer the hot thing?
Well, the question is if that's really going to happen, right?
That's a big bet to take, though, right? That because up until now, every milk alternative has gone on to be replaced by another one. Every single one.
But then again, Oatly is not just milk, right? They have ice cream. They have cream cheese.
Yeah. But I'm saying that it's all oat based, right?
Right. For now, but it's not really only. It's like
milk is probably like 80% of the revenue, I'm guessing.
Yeah, for now. But they're actually probably going to very soon move into cheese as well. So the possibility there are, because Oatly, people who don't know the company and the CEO, they're not actually probably not only going to be focusing on what you eat. They're talking about going into clothes. They're building a whole new trend. For them, it's more important that they actually make people try to wake up people that going into caring more about sustainability. So they're kind of like creating a movement here by their own. And their moats right now is their brand.
Yeah, I agree. They have huge potential. I just think there's huge risk as well. There's like a lot of risk of things that could go wrong, I think, personally.
So you would say, Jesse, Oatly's moats is their brand?
Right now, I would say that, yeah.
Would you say that's strong enough? Is that strong enough to protect against a competitor that releases a product that's half the price?
Well, it has been. I mean, here in Sweden, I know it's the same in the UK and Germany. They have those products that's half the price, and they've been there for years. Yet they still buy Oatly.
In my own house, people buy Jordan instead now because it's half the price.
Yeah, but that's your house though. But that doesn't really reflect on what's going on in the UK.
No, obviously, yeah. What I'd say is like you'd have to wait like another.
Right?
You'd have to wait like another year really to see if it is or not the case.
Yeah, I mean, there's always going to be people who chooses the cheaper alternatives, and that is not necessarily a bad thing because that creates more awareness, right? That there are other alternatives out there. So they don't need to conquer the world totally, right? They just need to take a pretty good chunk of it. So me personally, I'm really, really bullish on them, especially with the current valuations. They're crazy.
Yeah, I mean, projections look great, bro. I mean, they're planning to almost double their revenue full year 2021. Well, analyst expectations, the average is 1.2 billion, highest is 1.26 billion. The lowest is 8.82 million. So again, huge growth, sales growth for 58%. What's their financials looking like? So they got a strong balance sheet. So so they got 708 million in cash.
Yeah,
127 million debt. Current ratio is 5. Wow. Okay. Yeah.
So when it comes to plant-based companies, I would say on paper, they're probably the most attractive one right now on paper.
Yeah. Nice. Okay. Right. Let's check out. So that's Oatly, guys. I saw people asking for the ticker. And again, you can see the stock has been, it's been absolutely destroyed. The stock's really damaged, just like a lot of small caps.
And that's related to Spruce Point, which was a hedge fund in the summer that had a 124-page, and that was very different from what happened to Tattoo Chef because nobody almost knew about that compared to what was going on with Spruce Points. That was on all media outlets and all the bigger financials magazines. They talked about it nonstop. And there were legal ramifications. The only thing you saw in Yahoo Finance for like 3 months was a new legal firm attacking Oatly. That if you want to, try to get your money back, come to us. Like hundreds and hundreds of legal firms, but playing on what that hedge fund said because they were shorting the stock. They said that when we're around $25 to $29, they basically said that Oatly had been lying about their financials and they're not as good for the environment as people think. And they had the whole research thing around it, and nothing has been proven so far.
You know what I find really weird with Oatly, Jesse, is on the back of the box they've got the picture of the CEO and like they're really like praising him. I found that a bit weird, man. That's a bit strange.
Yeah, he's also kind of like Elon Musk personality. He's like he works nonstop. Basically, he eats one meal a day, and then just works.
Well, when you put your CEO's face in the box and you make it out like the staff have decided to do that to thank him and respect him, it doesn't look like that. Obviously, it looks like this. It's weird.
Pricey, man. £1.50 in Tesco.
No, it's normally £2 if you actually go in the shops. I think usually.
Oh really? Just online? Oh yeah, club card price. Yeah,
it's usually £2.
So £2.
£2 for how much?
For that
a liter, 1 liter.
Really?
Yeah,
it's way cheaper in Sweden. It's not that expensive.
Yeah,
that's why they have more market share in Sweden.
So Tab's asking, is Oatly GMO, Jesse?
I'm pretty sure it's GMO free, but I'm not 100% sure there. So...
Okay. All righty. Okay, guys. So I think that's about it, really. Is there anything you wanted to add, Fahim, bro? Actually, let's get to the questions. Let's see. Do you guys have any questions in the comments? Let's see. Okay, so we've answered that. We've answered quite a lot of your questions already, guys. Anyone got any views on Polestar? That's the electric vehicle company. They'll be going public.
I've been meaning to research into it, but I haven't yet, so I can't say anything. I've not really looked at it yet.
I think they're quite popular in Europe at the moment. Jesse, any thoughts on Polestar?
No. Oh yeah. It's a Swedish. Isn't it a Swedish company? Isn't it Volvo going together with?
It's Volvo. It's Volvo basically. It's Volvo.
Yeah. So I mean, I'm sure they're going to initially probably have they IPO now, or when are they IPOing?
They're going via SPAC. I think with GGPI.
This is my biggest question to EV investors, right? A company could make a great EV, but if in 2 years' time Tesla cracks FSD, what happens to that company's business? Like, who then buys an EV that doesn't drive itself when there's an EV that does drive itself? Like, who's gonna?
That's the biggest reason why I'm leasing a Kia e-Niro, which it's a great car, but like when people come to me and say they're going to buy a car, I would never buy a car right now. Because if it's not a Tesla, to be honest, but I'm super bullish on Tesla, of course. Because if you buy a gasoline car, a diesel car, or whatever, and in 2-3 years from now, the technology is going to be so great from Tesla that the cars are going to be much more inexpensive. They'll have their $25,000 car. Everyone's going to focus on that, right? If you buy another car like a Kia, for instance, that is an electric car, but the technology is going to be whack in 2 years from now, then you're never going to be able to sell that either. So me, right now, when it comes to cars, I would only lease if I'm not buying a Tesla, but I'm super partial. So
very biased.
I'm not invested in Tesla personally, but I do think, I personally believe it's going to be the largest cap company in the world within the next 5 years. You can hold me to that. If it doesn't happen, brother. I think it's going to happen. I think they'll be the largest cap company in the world.
I mean, you just have to look at their factories. Austin and Berlin's coming online. You're looking at the deliveries already. They've got a backlog of orders. Yeah, it's very hard to see anyone beating Tesla at the moment. But also in the UK, they're going to ban the selling of new
gas.
Gas.
Can I just answer a question that you said before about Oatly and GMO? And their page says that our products are non-GMO, verified.
Non-GMO. Okay.
Yeah.
Okay. So,
sorry.
Right. Okay. So another question from Eric Scott asking about DKNG. So DraftKings.
No thoughts.
Anyone invested in DraftKings got an opinion?
I wouldn't invest. That's me, my personal, no gambling company.
Oh yeah, no gambling. Yeah. For me personally, it's a bit hit and miss. Like I'm not bullish on the sector because there's just so much competition. Like I don't know what DraftKings does that separates it from other competitors in the space. And with that, I can't confidently predict how their revenue will be over the next 5 years, because again, the competition on gambling it's insane, and anyone can. The barrier for entry is very low, I guess. Well, in the UK, anyways, you've got like obviously your William Hills, your Betfairs, all of these other names. So
I think the best thing, I think that's an important thing, man. A lot of investors now, when you're looking at companies, the first question you need to ask yourself is, can somebody else do this? And how hard would it be for them to do it? That's definitely something to start off asking.
Yeah. What about yourself, Jesse? DraftKings, any interest?
No. Okay. Actually.
Enphase. I know that was a big one for Kevin, but now obviously he's dumped it. What's your thoughts? I think he had a huge 2021. Look at that run up, guys. It went up 388% from its pre-COVID highs. Anyone bullish on Enphase? Any buyers?
What's the market cap now?
The market cap for Enphase. Let's have a look. Oh, where are we? It's just dropped a lot, though. Right, Enphase currently right now you're looking at about 17 billion. Wow.
Oh, you know what? If you're looking at the analyst estimates, right, they're estimated to do around $1 billion in EBITDA in 2025. So even if they were to
2025, yeah.
even if they were to trade around a 20 EBITDA multiple, you're still only looking at maybe a 20 to $30 billion market cap. So I don't know if the risk reward is great on that.
You're paying 25 times sales.
Yeah. I
I
don't
think
that,
in this current market, that's almost suicide, really,
Yeah,
isn't it? Like
yeah.
when you've got so many companies trading,
especially when you have to look at margins as well, right? So like
Yeah.
T-Doc trades at 7 times sales but has 70% gross margins. That's a good deal. This
Yeah.
is trading at 25 times sales, and I'm guessing they probably got like what 20% maybe gross margins, if that.
They've got 19.5%
19, there
operating
you are.
margins. Yeah.
Yeah.
But I mean, it is growing though. I mean, look at that quarterly revenue growth, 96%. That's big.
Yeah.
That's big.
But they have to just look at the stage. Like, is that price growth? Is it growth? Is it priced in? Sorry, is the growth priced in? Probably is at 25 times sales.
25 times sales. Yeah. So I still think, even though you look at the stock price again, it could potentially be a value trap, thinking, oh, it's dropped so much. But if it's dropped this much, what was it trading at when it was almost $300?
Oh, you know one that's really interesting me. I haven't done my in-depth yet, but because I'm using it right now, it's Fiverr. I'm really interested in Fiverr. Really interested in Fiverr, especially after the drop, because I'm using Fiverr right now, and I'm starting to see why Fiverr has an edge on everyone else in the freelance space.
Have you used Upwork?
Yeah, but what I found with Fiverr is, they've started to create this Fiverr Business, Fiverr Pro, that really is going to help people have that confidence to use freelancers, I think, with what they're doing. So I'm liking Fiverr.
I mean, I was in Fiverr. I got into Fiverr. That was one of the plays I picked up during the March 2020 COVID crash. Sold Fiverr. I got in at about around about this price, and I sold it at $200. So I made some really good profits on Fiverr because it just absolutely took off. It was a COVID play. Yeah. But as a business, I mean, I haven't really tracked it. Are they still growing?
They're growing
now,
quite well.
10 times sales at the moment. Not bad.
Which compared to end phase, and the margins are much higher.
Margins, yeah.
You guys know the PS when it comes to the whole sector?
I think it's pretty much the same, to be honest, between Fiverr and Upwork. Those are the two big players anyway in this space.
All right.
The Upwork's so it's
But you know what I like about Fiverr is they have mind share. Like if you think freelance, you think Fiverr pretty much straight away, unless you start doing some research and come across Upwork. And I think that's a big thing when having that.
Upwork now has overtaken Fiverr in market cap.
Market cap, yeah.
Wow.
Fiverr had a big drop.
Wow.
I like this. Someone said that TTCF is a buy at 169.
We're going to get all the bears coming out, guys. Hold the line.
Everything money's going to have a field day.
Yeah. Right.
Strongman finance.
Yeah. I've seen some people have posted these videos recently. He's gonna blow up in this bear market. Especially with Meet Kevin pulling out now. Yeah, it's gonna have a field day. I think someone mentioned SoFi. I mean, they had some fantastic news this week. They pretty much are a bank now with the bank charter news. So fundamentals have increased incredibly well. What's your thoughts on SoFi, guys?
I'll let Jesse take that one. I've never really looked into
I don't know. They're a fintech company, right?
Yeah, so they pretty much deal with all types of loans, student loans, etc.
And Shamat was part of the SPAC, wasn't he?
Yeah.
So I did like that because Shamat is a bright dude, right? So, but my focus is still on the Square when it comes to that. But I have heard good things about them, obviously. And if they have started their own bank now as well, that does sound promising. But with that said, I have very little information about them, to be honest.
Okay.
But they seem very, very small comparatively to Square, I guess. I mean, Square must have like 60, 70 billion in market cap right now. So
I think Square at one point was over 58.
Yeah.
So, I like this comment that someone just put. People on YouTube think multi-bagging is what happens in a year. That's the truth. That's the truth.
I mean, the thing is, if you're coming from crypto, Do you know what I'm saying? Then fine. Yeah, you can. You can
You know what it
agree
is?
that, but
Even 2020, because 2020 was like
true,
50% a year, 60% a year. People don't know
true.
that really a stock moves maybe 10% a year. Maybe if
Yeah.
you've got a really good one, 12, 15% a year, that's in a year though, not a week or a month.
But I love the comment that I had from one in my Discord, Arthur. He said that this week Beyond had like 2 really good news items, and still it went down like 5% total in the week. And it's basically that good news when it comes to companies now that they would go up on that. That's so 2021 in the beginning of the year. So like,
same with Hims, bro. Like Hims announced a partnership collaboration with Walgreens. And the market's like, oh, you've just announced a partnership that's going to grow your revenue. Sell. I mean, like that's the current sentiment right now.
You know, I personally,
you're
I hope
doing well. No, get out of here. Get out.
What's
of
the
here.
short in Hims?
I hope T-Doc acquires Hims. I think they might.
You think so?
Possible.
I don't think. I don't think Andrew will sell.
The only thing T-Doc's missing is the pharmacy, the pharmaceutical side. Once they have that, they've got everything in the medical space covered.
And T-Doc doesn't really target millennials like Hims pretty much primarily do, you know. So I think that would be great. It'll be a great addition.
Don't they though? I mean, when you think about
T-Doc's kind of just everyone through your employer. They don't market to you directly as a customer. They get you through your employer, so they offer the insurance through your employer's health plans. That's
why I like Hims more. They're B2C really. T-Doc's more B2B in a way. Anyone looking at Clover Health? Clove. Someone mentioned in the chat.
Yeah, I was really interested in. And then when Shamat started talking about it, was it 1.5 years ago? And I started looking into seeing the interviews with the CEO, his buddy there, and seemed really interesting with that kind of idea behind it. But how's it gone? I haven't followed it for a long time.
Have you seen the chart? Are you looking at this, bro?
Oh my god! Are you kidding? Oh my god!
91% from his peak.
Wow.
Wow.
That's probably one of the reasons Shamat is not that popular right now.
Oh, bro, he's getting roasted on Twitter.
I know. Oof.
Are you guys ready for everyone to stop watching YouTube investing videos now?
I know. You see it in the comments though, like when you go and Meet Kevin's videos, people are like, "Oh, no more watching YouTubers anymore. ETC all the same, pump and dump."
It's a shame though when people try to help with genuine advice, they don't get views, so then people end up in the wrong place.
True.
But yeah, in terms of Clover Health, market cap's 1.1 billion right now. Let's look at analyst expectations. The average for next year is 2.6 billion, guys. So double what the company is actually worth in terms of the average analyst estimates. Current year, full year, expecting 1.45 billion average estimate. So essentially, they're going to make more than the company is worth right now in the top line.
Which company is that?
Clover Health. Yeah.
Oh my god, that's amazing numbers. I mean,
yeah. So 1.45.
They only have 5 analysts, right? So
yeah.
Okay.
Again, another one. It's growing right at 115% year over year. That's insane. Okay, let's take a look at the price to sales. It's currently.
But how much are they losing in terms
3
of
times
cash?
sales? Cash flow, operating cash flow is minus 262 million.
Yeah, see, because like Invitae is an example, right? The revenue is growing really fast, but they're burning cash like crazy, diluting shareholders constantly. So then what's that revenue really worth if your market cap's going to increase by 2 times in the next 2 years?
That's a good point.
Just through dilution. So yeah, definitely need to have a closer look.
They're fueling growth though, you know, like a lot of growth companies.
Yeah, I think it all depends on, do you believe that they're gonna eventually it's gonna work out or not? That's the thing. Like Tesla doubled or tripled their share count from IPO to now, but they brought shareholder value with it, right? So nobody's complaining that Tesla diluted.
Yeah.
But then lots of companies won't bring shareholder value. They're just gonna crash and burn after all that dilution. So
But dilution isn't all, depending on the situation, dilution isn't necessarily a negative thing, right?
That's what I'm saying. Like Tesla tripled their share count, and it was a good thing. They used it to build factories. They expanded their market share, but not every company is going to do that. So you've got to trust that management team, right, to do it correctly.
And in this current market,
if Elon Musk asked you for $10,000, you'd give it to him, right? You know he's going to probably make you a lot more money.
So I think everything for me personally, everything for Clove looks like it's going in the right direction. Yeah. In terms of growth. So, and the current valuations, 2x sales. Yeah, it's a. I think that's a good company to more due diligence, and I'm gonna put
with that price, that's incredible.
But
they were up at 29.
You know, what's Jeremy? He only ever shorted one stock, I think, in his life, right? Peloton, and oh my days, he called that one right? But he definitely sold his short way too early. He would have made some serious money.
I have to confess, I also shorted Peloton at $100.
Really?
And I closed my position at 91. That's probably my worst trade of 2021. Was closing Peloton.
Isn't it like 20 now, right? Yeah, it's like
Peloton right now. Yeah, is my Discord make fun of me for that. Yeah, it's at 27.
Wow. Yeah, they actually came out with news in the week that they're gonna start making less bikes now because their projections aren't looking too good. And I don't know, you guys might be too young for that. You guys heard of Sex and the City?
Yeah,
I've heard of it. Yeah.
They came out with a new series now, a new Sex and the City, but with the same cast basically. And one of the main cast there, just in the first episode, actually died when biking on a Peloton. So
are you kidding me? Wow.
Yeah. So they actually, I think Peloton made a commercial with Ryan Reynolds, where Ryan Reynolds is basically saying, when you're biking on this, it's really good for your heart and blah blah blah. But so really bad commercial there.
But it's a thing. You know, I can't remember who said it, but you know, Charlie Munger actually, I think. So you know, when you're looking at a company's revenue and earnings, you got to ask: are you looking at it in a normalized environment, or are you looking at it in like some hyper stage that's not going to last? So you're looking at Peloton 100% revenue growth, 50% earnings growth, but what's the environment you're looking in, and is that going to last? So that's also something I think important to keep in mind.
Very true,
for sure.
I mean, I've never been bullish Peloton. I just didn't really see what the hype was. A treadmill with an iPad stuck to it. You know, you're seeing reports with kids getting trapped underneath the Peloton treadmills. Yeah, I was never bullish, but someone asked like, what is your worst trade of 2021? And for me, it was selling Peloton at 91 and my shorts. What was yours, Jesse? Would you say
my worst?
Yeah.
Well, my worst. Well, one of my worst. I haven't sold. I actually bought because I was so excited about Oatly when I bought like for $5,000, $6,000, just a small sum in Oatly when it IPO'd around 22. But after 1 or 2 weeks, when it was up at 23 or 24, I started thinking I'm insane because this is gonna go so badly. So I sold it and I made a very little profit bonus there. But yeah. So I'm much more happier having an average now around $8.
That's not bad, man. That's not the worst trade. That's one of the good trades.
Yeah,
that's quite good. That was quite good. What about yours? I know you don't really trade much either, but
no, that's what I'm saying. For me, like I can say worst in terms of I'm down, like maybe Tattoo Chef.
What the hell is that? Oh, is that a cat?
Yeah, it's Mowgli. It's Mowgli.
Like trading it in terms of money, I'm down on, but not as in like I've sold and realized losses, because I'm just holding everything and I'm happy they're down, to be honest. So I'm having this has been my favorite year since like earlier, because everything's down. Like I'm happy that it's finally down, and I can be more comfortable that I'm going to make good money in the next 5 years.
Nice. Right. Someone said nice cat.
It's Mowgli. It's Mowgli.
So is that the beyond? Is that the beyond cut now, right? So
Beyond.
Exactly. He's a little beyond the cat, that's for sure.
All right, gents. So I think we're gonna call it. We're gonna wrap it up here.
Yep.
Thank you guys so much for tuning in. Quite a lot of you guys tuning in for your questions. And the main thing, guys, is look. I think the main takeaway is we're currently in the bear market. It's absolutely normal. Stock market doesn't only go up, but in bear markets is really where your long-term thesis will be trialed and tested. Just stay calm. Warren Buffett talks about staying objective, focus on your due diligence, the companies that you've invested in. Don't panic, sell. None of this financial advice, but,
No.
don't panic, breathe. And we're going to get through this. It's just part of investing. There's going to be down periods, but stay the course and don't panic. So, I mean, do you have any advice? Well, do you have any non-financial advice, Fahim, for people in the current market?
Yeah, same thing I would say is make sure you build your conviction before you buy a position. Don't buy because I buy, Jesse buys, or Emmanuel buys. Make sure you build your own conviction so you can make the right decisions when things are going down. And I'd say if you haven't learned how to value a stock, learn how to value a stock, because once you know the fair value of something, where it's going, that's what will give you the most confidence to hold and buy more when it falls below certain prices. So definitely learn how to do that.
Yep.
Yeah.
So information is power. Yeah, knowledge is power in this business. So get convicted, understand the business, understand their future, the whole sector, what kind of CEO is, I mean, when it's growth companies, obviously financials isn't the only thing, but it is still important. Don't forget about that. Really look into the financials as well, and the possibilities that what they could bring in, and what makes sense to you for sure.
Yeah. And I mean, I'm not trying to plug our Discords or whatever, but I think if you want to be part of a community, sometimes together there's strength in numbers. You can check out Jesse's Discord. You can check out Foolish Discord. You can check out my Discord. Also, check out their channels. I'm not just bringing anybody onto my channel. I trust you guys with the information. They're not pump and dump artists. They're in this. They've got skin in the game. As you can see, they've got good head on their shoulders. So check them out, guys, if you haven't already. And thank you guys for tuning in. All right, guys. So we'll catch you. We're probably thinking of creating a channel.
I was wondering if you're going to mention that.
We are considering it. So let us know if you think we should create a channel and maybe do a live stream, something like this, maybe once a week. If there's demand for it, then we'll.
I already see people saying, I've got Hearts Tube saying, please more. Liam saying, look forward to your next one. Yeah, I think maybe.
Yeah. I can see it. Yeah, some people said they got. So we're probably going to create a channel. So once we do, we'll let you guys know, and then we'll try and do one of these live streams. You guys can pick our brains and whatnot, and that'll be great.
It's going to be called Plant Stocks 2, right?
No, it's not. It's definitely not going to be called.
I thought it was all in beyond meat.
All in beyond. But we'll let you guys know once we've created it. It will hopefully be this week because there's clearly demand, and we appreciate every single one of you guys. For sure. So we're gonna get through it together, guys. Don't panic. Nothing to worry about. If you haven't got any money to buy any more dips, then just sit on your hands, enjoy the ride, because we're gonna go through it, and eventually the market has always gone up and to the right. So that's it really. We'll catch you guys in the next one, guys. Take care.
Yep. Peace out.
Peace.